Before we go into the Astrea VI transaction, I would like to spend some time to talk about private equity, which is the underlying asset class of the transaction. The private equity primer will provide some insights on the portfolio that the credit of the Astrea VI PE bonds are based on. Private equity in general refers to investments in private companies. Majority of the private equity investments are made by private equity funds. The PE funds are managed by private equity managers, also known as general partners or GPs. Investors are commonly referred to as limited partners or LPs. The GPs of the fund strive to make operational improvements and create value to these companies before selling them for a profit. Private equity investments is common around us. As general examples, you can see many familiar names, brands, or companies that are invested by private equity funds. As shown in this chart, you can see that the private equity market has grown significantly in the last 20 years, growing at an annualized rate of 11.7% to reach $5.8 trillion in June 2020. There are various strategies in private equity, like buyout, growth equity, real estate, private debt, and venture capital. Of the various PE funds strategies, the buyout and growth equity strategies have produced consistent median returns of 13.8% and 12.6% respectively. Buyout funds focus on purchases of controlling stakes in companies, while funds that employ growth equity strategies invest in companies seeking to grow. The Astrea VI portfolio is strategically weighted to both buyout and growth strategies. In terms of returns, private equity as an asset class has also outperformed the public markets over the longer term. Here, you can see the typical cash flow profile for an investor in a private equity fund across its fund life that spans across more than 10 years. In the initial years of the fund, there will be cash outflows as the GP draws capital to fund their investments. These cash outflows are represented by the pink bars. Over time, once these investments grow and become profitable, the GPs sell them and generate returns for the fund, distributing cash back to investors. These cash inflows are represented by the purple bars. So you can see that cash generative phase in the life cycle of a PE fund is in the later years. This is represented in the shaded area. The net effect of the cash outflows and inflows is represented by the gold line. This is also known as the J curve because of its shape. To ensure more certainty over cash flows, Astrea portfolios only consist of secondary PE funds, meaning that the funds are in the later or mature phase of their fund lives when they are more cash generative. The portfolios are diversified with many underlying investee companies and are managed by quality fund managers. When a portfolio of PE funds is constructed, it can have superior downside protection versus investing in a single PE fund. Here, we compare the risks of capital loss of a single PE fund, a primary fund of funds, and a secondary fund of funds, using the historical data from Preqin, which is a database provider covering more than 7,500 funds from 1990 to 2016. A primary fund of funds is one that invests at the inception of the funds, whereas a secondary fund of funds refers to interests in mature funds like the portfolios in the Astrea transactions. As shown on this slide, investing in a portfolio of secondary fund of funds has competitive risk-adjusted returns, with only 2% of secondary fund of funds experiencing a capital loss. That is why Astrea VI portfolio is well diversified, mature, cash generative, and has lower risk of capital loss. PE is traditionally a very inaccessible asset class due to the high barriers to entry. The minimum investment sums for PE is high. The holding period is long, and individuals have limited access to good funds. However, our Astrea VI bonds can mitigate these barriers to entry and connect investors to private equity through the following. 1. Astrea VI bonds allow for bite-sized investments, which means investors do not have to put in large amounts of capital in order to invest. For the Class A1 bonds, the minimum subscription is 2,000 Sing dollars, and the bonds are traded in denominations of 1,000 Sing dollars on SGX. 2. Investors' capital is tied up for a shorter amount of time. The Astrea VI Class A1 bonds are scheduled to be redeemed on year 5 if conditions are met. 3. The Astrea VI bonds are backed by cash flows from a mature and diversified underlying portfolio that mitigates the risk of the J-curve effect. I hope that this segment provided a clearer picture of what the asset class of private equity is all about. Thank you.